How's it going?
It's going great. How are you?
I'm doing good. I'm doing good. What does shooting a bird mean? I don't think I like that expression.
No, that'd be bad.
How's your day going? Is it beak or bleak?
It, it's going great.
Someone told me that if you're not prepared for a presentation, you should just wing it. It'll
That's
the
true.
time the time will fly by. So, uh, sorry that you're going to have to present with Alan. I hear he's pretty difficult and he makes stuff up as he goes along.
I, we'll have to see.
Okay. All right. Well, bye. Hey, Peter, how you doing?
Good. How was my improv?
Yeah, very good. Very good. Oh my gosh, there's a mouse on my desk, but it's an Apple Watch. Anyway. All right. Welcome everybody to this production of Year-End Tax Planning by the Numbers. We're going to talk about what you can do to save tax money and, more importantly, to support your tax advisor. And I have Peter Farrell here. He's a lawyer in our firm, a very, very bright lawyer. He has a master's degree in tax law from the University of Florida. And we applaud Professor Dennis Calfee, who had an 80-year birthday celebration. And there were about 700 people there at the University of Florida, I heard, congratulating Dennis Calfee. So those of you who are on this call, if you have a lawyer who went to the University of Florida Law School, or you were a lawyer, or you are a lawyer who went to University of Florida, you join me in congratulating Dennis Calfee on his 80th birthday. And I just got a phone call from somebody, so I will turn off my ringer, of course, and let's get started. We're going to show you some tax planning using our Estate View software and the new AI feature. So if you just open your browser, and if you're using Google Chrome, that's at the top, put in estateview.link, and then select Pro Plus, and this is the secret code word, don't tell anyone, all caps, free trial. You'll get 10 days use of Estate View, and you can do some of the things that you're going to see me do here. And then you can join Peter in a master class any Wednesday or Friday at noon, and he can answer your individual questions. Peter lives to give Estate View master classes. Now, the good news from the estate tax arena is there's really not much that you need to do before year end this year. In fact, I talked to a client yesterday about a gift that he wants to make very quickly before a company has some great progress, which, oh, I'm not sharing screen. I apologize. Let me share screen here. It's opening up share screen. Slowly opening up share screen. And let me find the screen I'm using. Sorry about that, everybody. But maybe that's it. That's it. Okay. So we're going to start over. First, there was a bird. He said a lot of funny things. Then the show got worse. If you want to use Estate View, you see page 2 here. I apologize that I didn't have my screen sharing on. Put estateview.link in your browser, select Pro Plus, and then all caps all caps free trial, one word, and then you can use our AI engine, which I think you will enjoy. All right. Now, my PowerPoint's not working. It's not letting me move the screen here. Peter, I think we may have to use your PowerPoint.
Okay.
But while we're at it, while we're waiting, and I apologize that I don't know why my PowerPoint froze up. I'm going to show you one thing I just did for Estate View while Peter gets his up. And that is I put Elizabeth Warren's income tax return into Estate View by starting the new search, going to income tax return, putting her income tax return in. And I asked what Elizabeth Warren and her husband could have done this year if they have the same situation as last year. And they recommended capital loss harvesting. They recommended more municipal bonds instead of taxable bonds. And they recommended the possibility of retirement plan contributions for her publishing business, possibility of setting up an S corporation for her publishing business, and then they said to make sure her publishing business is a true business to get the 20% qualified business income deduction. And they talked about charitable planning. She could have given more to charity. They discuss a charitable contribution well over her exemption, which we will talk about. And then they talk about Massachusetts municipal bonds. They gave her action items, and they gave her caveats and limitations. So you could just put your client's tax return into Estate View or another AI, and they also will also tell me all her sources of income for my estate tax planning, just an idea. So now we have Peter's. Peter, are you sharing screen now?
I am, and I can change it. So.
Okay, great. Thank you for that. Don't know why this thing froze up. So on the estate tax side, before we get into the income tax side, which has a lot more moves, it's never too late to start your estate tax planning. We have a client who's going to make a very large gift very soon. And he said, I think I'll just give the gift in January 1st as opposed to December 31st. And the reason is he doesn't want to have to file a gift tax return for then a year and a half, or actually longer than that, a year and 9.5 months when the gift tax return is due. So, sometimes it's better to wait. On the other hand, if he makes the large gift this year, it's less likely that the IRS will audit it, I believe, because they have way too few estate tax and gift tax lawyers in their estate and gift tax division right now. And they may be more populated 3.5 to 4 years from now when the statute would run, as opposed to 3 years from now, or et cetera, when the statute would run. The other thing is, we're giving his mother-in-law a power of appointment over this trust. And if she dies and exercises the power of appointment, we can use her GST exemption instead of the client's GST exemption. And he's interested in doing that. And he's the one who brought it up. So that's a very bright client. One thing I'll show you if we have time is that just making a $19,000 gift this year that maybe doubles in value every 10 years, that's a $38,000. Let's say it's 20,000. That's 40,000 in 10 years, 80,000 in 20 years, 160,000 in 30 years, and 320,000 in 40 years. So anything that you can give this year for a client who may be on the fence as to whether to use their annual gifting exclusion, and whether that's done by giving directly into 529 plans or discounted gifting of LLC interests, and getting multiple owners of their LLCs, which can be a trust for the children. Getting it started now gets the asset protection started now. The estate tax exemption will be moving from $13,990,000 this year to $15 million in 2025. For clients who have used their entire $13,990,000 or a big part of it, that basically gives you another $1 million to gift on January 1st. And Peter, as you know, a lot of our clients who do annual gifting will do it every 2 years. So for example, if the client has not been doing annual gifting, we can make a gift December 31st and January 1st and get 2025 and 2026 done immediately. And then we can wait until December 2027, give them basically 2 years off before we bother them again. Now, from a time value of money standpoint, it's better to gift every January 1st, but from a my lawyer is a pain in the rear standpoint, it may be better to gift earlier rather than later. So it's always time to do estate and gift tax planning when you have estate and gift tax exposure. It also goes into flu season. As a law firm, we see a lot more clients pass away quite candidly between now and March, April. So it's always a good idea to give grandma a big hug on Thanksgiving and get her estate planning done before flu season. And maybe don't breathe on her either. Peter, anything to add to that, or should we?
We'll keep going in the slides.
Yeah, and just hoping that this presentation will get better soon. So let's go to the income tax side of it. Okay, so there's a Wall Street Journal article, and it is my favorite Wall Street Journal article of all time, and my second favorite Wall Street Journal article also mentions me. But in this Wall Street Journal article, in order for Marcia and I to be able to, in essence, deduct the cost of the real estate taxes on our vacation home, because we are over the cap and we personally only get a $10,000 a year deduction for property taxes, we are setting up a trust. Peter, I forgot to ask you to set this trust up before January 1st. And this trust is going to own our vacation home and income producing bonds. And instead of Marcia and I paying taxes on these income producing bonds, it's going to be income to the trust. The trust will be a separate taxpayer. This is what we call a non-grantor trust at tax parties. And what will happen is the trust income will pay the property taxes for that vacation home, and that will be a deduction of up to $40,000 a year. And in addition, we're going to put bonds in there that are going to have more income than we need to pay the property taxes on the vacation home. And that trust can sprinkle income to our children, grandchildren, and nieces and nephews, and will be taxed to them at a lower bracket than the trust would pay and that we would pay. A non-grantor trust reaches the 37% tax bracket and the 3.8% Medicare tax bracket at what, Peter, about $13,000 a year?
Yeah.
So everything over about $9,000 is going to pay property taxes and help family members. It could help friends as well. If we wanted to give money to some friends, we could give them money. They would pay the tax at their bracket, and that's going to save us a few $1,000s a year. It's going to save us a lot more than the cost of the trust and the deed every single year. So thank you to the Wall Street Journal for mentioning me. That's the second time. The first time was in 1992. It's been a long, dry period. All right, so what do we have next here? Folks, we have 45 more minutes of riveting excitement for you. So that was the SALT deduction, state and local taxes. So now, and by the way, there's ways that you could click on the little hamburger there. They call it a hamburger just below our pictures. You can put your cursor on those horizontal lines, and then you can move it up and get rid of us and see the picture a lot bigger. And also, if you're watching a replay, because most people who watch these videos watch them over and over and over again. So you can go to your settings at the bottom right if you're watching this on video, and you can increase the quality. They call the HP, so then you can see the screen better. You could also
mute us.
What's that? You could also mute us. That would be a good idea as well. All right, Peter. So I'm going to let you now talk about the aquarium.
All right. So I'm not sure if this aquarium is going to be helpful to you or not, but hopefully it is. So there have been some changes this past year in the federal income tax charitable deduction, that as we're thinking about year-end planning and things you might want to do before the end of the year with respect to charitable giving, it's important to understand how things are going to change starting next year. So I'm going to go to the next slide to show how we've had, if you've watched Alan's presentations regarding charitable giving before, you've probably seen this illustration. One thing that's coming back that we had before and it phased out, but they brought it back, is for non-itemizers. There is now starting next year, $1,000 deduction for cash contributions to a public charity. So that's good for non-itemizers. And then for itemizers, we're keeping the AGI limitations that we had before, and you see those illustrated here. For instance, there's a limit of 60% of AGI for cash contributions to a public charity. So as a background, we're keeping those things. But here's how this fish tank works. Hopefully it's helpful to you. So we have at the bottom, again, what I just mentioned, we're talking about nine itemizers will be able to give $1,000 for an individual or $2,000 if you're filing jointly to cash contributions to a public charity. Now, what we're trying to illustrate on this next layer is the idea that a taxpayer effectively loses charitable deductions to the extent that $32,500, which that's for a married couple, exceeds the total of non-charitable itemized deductions. So that's easier to say it as an example. So if there are non-itemized charitable deductions of $22,500, and the client makes a charitable contribution of $100,000, they're effectively losing $10,000 of the charitable contribution because they can just take the standard deduction. So that's what we're trying to illustrate on this next level of the aquarium. All right, here's what's all of that other than the $1,000 is not new, but we've added you're going to add a couple of things next year. The first is a 0.5% floor for charitable contributions. So all of your they're deductible. The charitable contributions are subject to a reduction of 0.5% of AGI. So if you have $1 million of AGI, you'll lose your first $5,000 of the deduction. So that's one reason why you might want to make contributions before the end of the year. And then again, we keep the cap. So the AGI limitations that are illustrated on this chart on the next slide. And with those AGI limitations, you are able to carry forward the amount that was disallowed. And if you are able to carry forward part of the amount that's disallowed by the ceiling, you're also able to carry forward the amount that was disallowed by that 0.5% floor. And I'll mention also for C corporations, it's 1% of AGI. Now, if you think about that, you're carrying it forward, but it keeps applying every year. So, and we have a fish. Does the fish have a question?
Oh, well, you're doing good. Keep going.
Okay. So even though it's a carry forward of that floor, it doesn't particularly help you because you're gonna that same floor is going to apply every year thereafter. Last thing to mention about new rules for the charitable deduction is this 2/37 rule, which when you actually track the rule is pretty difficult to explain and pretty difficult to understand the logistics of it. But the most easy way to explain it is one, if you're familiar with the piece limitation, they're just bringing it back with a different percentage. And basically, it just limits your tax benefit, not just to charitable deductions, but to any itemized deductions to 35% per dollar instead of 37 cents if you're in the 37% bracket. So that's basically the effect of the 2/37 rule. All that to say, making charitable contributions before the end of the year you will not be subject to that 2/37 rule. You'll not be subject to the 0.5% floor. So it may be a good idea to make some of those contributions now.
Okay, so let me make sure that I understand what you just said. So anyone who's a taxpayer can donate 1,000 if they're single or 2,000 for a married couple to charity and get a deduction no matter what their income bracket is, no whether they itemize or don't itemize.
It's only if you don't itemize.
Okay, so that's only if they don't itemize.
That's right.
All right. So then a taxpayer who is single automatically gets a $15,750 deduction. And that's called the itemized deduction. That's called the
standard deduction.
Standard deduction. And if you have property taxes, deductible medical expenses, and interest income exceeding $15,750, then you can take the greater of that excess amount or the $15,750 as a tax deduction. And that's where if you give to charity and you give charity 10,000 and you have 5,000 of other itemized deductions, you're only at 15,000, you get a 15,750 deduction automatically. It did not help you at all. So that's why the fish is frowning, not because of the quality of the presentation, but because he did not get a deduction. Now, if you get above, and by the way, the married couple deduction is $32,500. If you get above the $32,500 for married or $15,750 for single, then you get the deduction, but only on the excess. And that's why, let's say your itemized deductions include 10,000 of charity every year, but are only getting you up to 30,000 a year in deductions. Well, you would have gotten a lot of that deduction from the 10,000 to charity without giving that money. So that's where, if you're going to give 20,000 a year to charity for the next 5 years, you're better off giving 100,000 right now and getting way above the standard deduction, getting more deduction per dollar, and getting the deduction now because of the time value of money. And that's why the fish is smiling above the standard deduction. But if you go above this cap that we're showing there, that's where the fish starts frowning again, right? This is what they did in order to make this tax neutral, that they're giving all these new taxpayers a $2,000 or $1,000 tax deduction. They are now socking it. Who else would you sock it to? The rich, and saying you're going to lose your charitable deduction to the extent of 1/2% of your adjusted gross income. So if your adjusted gross income is $1 million, 0.5% of $1 million is at $5,000. If Peter, or 50,000? It's 5,000.
Yep.
So 5,000 times 37% is $1,500. So if your adjusted gross income is $1 million, you just paid an extra $1,500 in taxes because you can't deduct your whole charitable deduction. So we had a meeting this week with a client who's at about a $200 million adjusted gross income. So for that family, they lost a pretty big part of the deduction. It's going to cost them an extra $300,000 a year on average to continue their charitable giving. So the moral of that story is give in 2025 before this silly 0.5% rule works and this silly 2/37 rule. Now, what is the 2/37 rule? This is Congress telling you that if you're in the 37% bracket, you only get a deduction as if you were in the 35% bracket. So it's a reduction of your deduction by 5.41%, because 2 divided by 37, everyone knows that's 5.41%. So
that answers one of Abigail's questions. She had a couple other questions. Does the 2/37 rule apply to trusts? It does apply to estates and trusts. Does the 0.5% floor apply to trusts? No, because it applies to Section 170.
Okay, but what's the controversy about Section 68E as to whether that trust that Marcia and I are setting up for the house, when it gives to charity, will it be subject to these cutbacks? Because some people say it will, and our research paper says it won't. Do you recall that issue?
I do recall the issue. I don't have much more to say about it than that. I'd have to have the code in front of me to.
Yeah, I think it's the 5.41%. Yeah. It's the 5.41% charitable cutback may not apply to a non-grantor trust. So 2026 is going to be the year of the non-grantor trust. And now, just as a reminder, because December is one of my favorite months. Well, the reason it's one of my favorite months. Oh, am I sharing again?
Or can you are sharing again.
Okay, yeah. I did Control-Alt-Delete and then eliminated PowerPoint and then brought it back up, and I'm back in business here. So please.
It just went away. I think it just went away.
What went away?
I don't think you're sharing it. You were sharing, and now it looks like you're not.
Let me share again. Sorry about that. There was once an app called Honey and Share, and they were pretty good. So, but I think he started sharing with the wrong people. But anyway, so your charitable deduction up to $1,000 in cash if you're single, $2,000 if you're married. And then if you want to set up your own private foundation, and that's why December is my favorite month, because we get to set up usually 3 to 5 private foundations for people who say, I'd like to have my children run the charity. I'd like to run the charity myself. I'd like to do charitable things in my community and not just give money to a charity. I'd like to keep this private. I'd like to get the tax return done. I'd like for Alan and Peter to set up a charitable foundation for us so that Peter can put his children through college. So anyway, you could give up to 20% of your adjusted gross income in appreciated stocks to your own private foundation. Or if it's a operating foundation where you do something that's active, like a active scholarship fund, then you could donate an appreciated building, and a lot of that happens before year end, or you could donate up to 30% of your appreciated assets to a private operating foundation. If you, of course, donate to a public charity, which can include a donor advised fund, or a community foundation, then you can get a 50% of adjusted gross income deduction. If you donate cash only, you can get a 60% of adjusted gross income deduction, but almost nobody does that because it doesn't really have a great advantage. And then if you're over 70 and a half, you can move up to 108,000 per person of your IRA directly to charity. And that can have a great impact because that is taking away ordinary income tax that you would have paid. You could base it just on your minimum distribution amount up to 108,000, or you could do more than that and go ahead and let the charities enjoy it earlier. You may, if you have a large IRA and you're charitable, you may as well give the whole 108,000 as soon as you turn 70 and a half. Why is it 70 and a half? Well, these two congressmen were fighting about it. One wanted 71, one wanted 70, and they came in at 70 and a half. And that balanced something else that was going on at that time. Maybe painting the White House or something. I don't know. Mm-hmm. All right, so that's enough for charity. And there's a lot of slides here that can further confuse you. Let's talk about quickly slide 39. Thank you, Mia, for putting together slide 39. Mia is a law student at Stetson Law School. And next year we'll have the senior deduction, but if you're over 350,000 of adjusted gross income, that doesn't help you. And the Section 199A qualified business income deduction continues to be a strong player and is phased out at 544,000 unless you have an active business that is not a personal service business that has enough employees and enough property. So if you're not getting that 199A deduction, talk to your accountant and lawyer about what it might take to get the 199A deduction to save income tax next year. For example, I'm not able to get a 199A deduction for the income of the law firm because I'm over that 544,000 because of how little we pay Peter. But I could set up a management company that could manage my law firm, and then I could have my children or a trust for my children, which also benefits my spouse, own part of that management company, and then get a lot of the income taxed at a lower bracket. Now, that's nothing necessarily to do this year. It could be done by the end of this year, but at least have it in place for next year. And those of you who are lawyers and accountants, if you're also getting trustee fees, personal representative fees, title insurance types of fees, speaking fees, publishing fees, you can put those into a separate entity and get that 199A deduction. It may not be too late if you talk to your accountant to recharacterize that income that you've gotten this year so far in your firm to really have been personal income or income of an S corporation that you may own in order to reduce the tax rate for those items. So Peter, anything else that you would want to mention relating to the phase outs?
Don't think so.
Okay. So we're going to go to the 199A planning. I've just got slides here beginning at page 68. We find that a lot of clients are not doing the 199A planning that they could do. This on page 72 shows a family situation that we helped design a couple of years ago that is saving the family $125,000 a year in taxes by having children and grandchildren be beneficiaries of irrevocable trusts that really benefit the spouse most, but are considered as owned by the children and grandchildren. So if you or your clients are out of the estate and gift tax game because you're under the $15 million exclusion, and you have a little bit more time, then maybe you can go ahead and do all of that savings. Page 75, we're talking about stacking those itemized deductions. Page 77, using your $19,000 allowance to fund 529 college savings plans for children, grandchildren. Some clients, for some reason, only fund the 529 plans ratably until the child reaches college. It's better just to fund them immediately. And if you're worried about estate and gift tax issues, you can do 5-year forward funding. So this year, I could put 19,000 times 5, which is $95,000, into a 529 plan, get all that growth going forward tax free if it's used for education and educational expenses, which have been expanded to include vocational education now. And my 529 plan that I bought for my daughter can move to my granddaughter, or could move from my daughter to her husband, to a stepchild, could move back up to me. I could move it to my brother could move it down to his child, etc., etc. They can only move to related parties. Even if you take the ordinary income out of the 529 plan in 15 years, the fact that you deferred the tax and the fact that it comes out pro rata, unlike an annuity where it comes out worst first with a 529 plan, even when you take out 10,000 to buy a car, if it's only grown by 30%, you'd only have 3,000 of income that comes out plus a $30 or $300 excise tax. So Peter, you want me to, or do you want to go ahead and talk about 168K and section 179? I've got them asleep now, so most of them aren't going to notice, but you might wake them back up.
All right. Well, maybe go to the next slide. I'll start with 168N, which is a new provision of 168. So this allows a taxpayer to deduct 100% of the cost of what's called qualified production property in the year that it's placed into service. Now, qualified production property is non-residential real property. It has to be an integral part of producing a qualified product. We'll talk about that in a second. It has to be placed in service in the United States or a territory. The original use has to be with the taxpayer, so you can't set it up and I think under these rules, lease it to somebody. The taxpayer has to use it. The construction has to begin, as you see, after January 19th of this year and is completed before 2030, and that the taxpayer has to place the property into service before 2031. So what the products that the facility has to make, it includes any tangible personal property other than food and beverages prepared in a retail establishment, tax-exempt use property, and a number of other things. But we're thinking widgets and the production of tangible property. And then there's also a rule if the taxpayer ceases to use that qualified production property to produce those qualified products within 10 years after placing the qualified production property into service, there's bad consequences. The taxpayer is treated as if it sold the property for the original cost basis and will recapture the gain under 1245. So that's 168N.
So let me just stop you there. Let me just stop you there, because in my lifetime I've never seen this. So if I make widgets, or right now I sell widgets and they're all made in China. So I'll just set up a factory. It'll cost me $5 million to buy the land, build the building, and put all the equipment in. What part of that is deductible under section 168N when I place this in service? Is it everything? The land, the building, the equipment, the furniture, even the puppets I buy to put in there?
I
I think it's everything.
I think I think it's everything. I mean,
I've
the
never in my
yeah.
career have I seen where you could take a building and deduct the whole thing in the year you acquire it. So this is a very aggressive play by the U.S. Treasury to say, let's manufacture things here. So all these artificial intelligence generator systems and all these electrical systems being built to fuel this is all being paid for 37% by the federal government right off the bat. So that's pretty notable, I think.
Yeah.
And so the sooner you get it in service, the better off you are. Now it's probably a little bit too late for most of the people on this call and our clients to go find production facilities, but that is quite an attractive thing. Now how is so that's 168 in.
If you go back up, we can go back. We can talk about 168K, the changes to 168K.
Okay, K, that's potassium, isn't it?
K is potassium.
Yep.
So 168K isn't new, but the new act restored the deduction to 100%. It previously was phasing out. So as a little bit of review about 168K, this is also called bonus depreciation. You can see that on the slide. You could depreciate certain, and again, we have another term here, qualified property, which we'll define in a second, in the taxable year that the property is placed into service. And qualified property is basically all tangible personal property with a depreciation period of less than 20 years. It also includes computer software, and there's a lot of provisions for the entertainment industry with regard to film and television and theater productions and so on. So under 168K, you can deduct appreciation. You can deduct the bonus depreciation equal to the applicable percentage. But now that was reducing. It started at 100% and it went down by 20% over time. Well, now under the Act, it's restored to 100% for property placed into service after January 19th of 2025. And now that is permanent in scare quotes until they change it. But right now it is permanent until further notice. And so now a taxpayer can deduct 100% of that and the cost of the year that it was placed into service. Any comments about that, Alan?
No. So then Section 179 does the same thing for the same stuff with a full deduction?
Yeah, there is some overlap between these. I think we have a chart somewhere showing that. But yes, there is some overlap of the property. So of the property included in each of these provisions.
So every year we have clients who buy airplanes, sometimes jets, and boats, and put them in service, either for an existing business that needs an airplane or a boat, or the client sets up a charter company. In order to deduct the whole cost of that $10 million boat or that $8 million jet airplane, you should not use it personally whatsoever in the year of acquisition, and you must charter it to an unrelated party at least once, and it has to have a sincere business reason. And then in order to get the write-off under the passive loss rules, your client has to spend at least 100 hours on this business, and no one else spends 100 hours, or your client has to spend at least 500 hours. So what can be done, and this is following the law, is you buy the boat or the airplane, or maybe an RV would work. You buy it in December, and then it's only used for the charter, only used for the rental. at fair market value, at least one unrelated renter, could be a friend but unrelated, actual rent. You get the whole deduction on your return. You do it through an S corp, and then January 1st, you cause the S corp to be a C corp, and your client does use the property, but they pay rent when they use it. They pay sales tax if there is sales tax on the rent, and then they rent it to others as well. It continues to be a business type of entity. They don't have to rent it to others. It looks better if they do. Now, eventually, when the boat gets sold, there's going to be a big old tax on the sale of the boat. You'll be giving Uncle Sam his money back at that time. But also, this works on the large cars. Peter, do all cars, do you know offhand, do all cars get a write-off, or just still the big cars?
I don't know.
I've always been humored by that only big gas guzzling cars get that deduction. I also like it when I get an email from a client who's in their jet airplane or on their $10 million boat, and the email always says, consider the environment before you print this email. Okay, so that talks about depreciation. What's changed in qualified opportunity zones? Now, the qualified opportunity zone is a place on the map, and the realtors know where they are, and you can find it on the internet. You shouldn't be looking for anything else on the internet, but you can look for qualified opportunity zones. And if you have a capital gain during the year and you invest up to the amount of that capital gain in a qualified opportunity zone into a trade or business that is located in one of these zones, and trade or business could include a car wash, could be rental property actively managed, could be self-storage, could be a milkshake shop, could be a Subway sandwich shop. Any of those are businesses. Then if you hold it at least 10 years, when you sell it, you pay no capital gains tax when you sell it. But Peter, how does the deferral of payment of the capital gains tax work?
Sure. So a couple changes. One thing is that the program has been extended indefinitely, which, as Alan mentioned. Now, one new thing is that investments that are made after 2026, so after December 31st of 2026, the gains that you are deferring through investment in the Qualified Opportunity Zone program are now recognized on the 5th anniversary of the investment date. Previously, it was a fixed date. And so now the Act, the Big Beautiful Bill Act, has made permanent that 10% basis step-up benefit, which will take effect immediately before the end of that 5-year period. So after, in this case, just we're talking about after December 31st, 2026, the end of next year, any gains that you didn't prematurely trigger because you sold or exchanged them out of the QOF will have that benefit of a 10% basis increase in the basis of the property.
Okay, so if I sell an asset, and maybe we need to look this up if you're not sure, because of the slide, I think I showed the wrong slide here, but if I sell an asset this year and get $1 million capital gain, then sometime early next year, I can invest up to $1 million. I don't have to invest the sale price like you would in a 1031 exchange. I just invest the capital gain amount into a qualified opportunity zone. If I do it from a capital gain in 2025, I don't think I get the 5-year deferral of paying the capital gains tax. I just get the 10-year sale benefit. Is that right?
I think so.
It sounds like a sale in 2026 may not qualify either, so I may want to hold on to that capital gain asset to 2027. But let's send an email to all the attendees and make sure we nail that down. I know it was in a slide, but the slide.
Yeah, I think it's slide 124. Run if you want to go to 124, and probably should have moved that up. But
All right, there we go. All right, so no capital gains tax until the earlier of 5 years after the date of investment. We're going to double check that because I don't think that this apply. I don't think the 5 year deferral applies until next year. By the way, while we're on page 125 with 9 minutes left to cover 90 things, there are these Trump accounts where, is this correct, Peter? Every time a child is born, $1,000 gets put into a Trump account that child can draw uh, on the 17th birthday.
Yeah, if they're born during that period, I think that's right.
Right. Now, employers and parents can contribute up to $2,500 to that Trump account, but it's not nearly as good as a 529 plan. So whether you like President Trump or not, the Trump account, the first 1,000, yeah, I will take it. But because you have to pay tax on it when you take it out, and because of the limited things that you can use it for, a 529 plan is going to be better for everybody. So, Peter, what?
So maybe not having one planning technique isn't to have another child before the end of the year.
Right, have a child before the end of the year.
Child before the end of the year.
Yeah, ask that doctor to hurry up and deliver that child. Okay, what page do you
I
think
think maybe we want to go back to page 87. I apologize. I had you jump forward, so we skipped some things we might want to.
Yeah.
We went from 87 to 124.
Okay, so section 1202 stock is stock in a C corporation that is an active trade or business. And when you sell the C corporation, if this exemption applies, you don't pay income tax, or you pay it, or depending upon what the law will be, it might be you'll pay income tax at 50% of the capital gains rate. And historically, you could only have up to $10 million excluded. But that's been changed to 15 million, and it's 15 million per taxpayer. So before the sale, you could gift 15 million worth of stock to your son, give 15 million stock to your spouse, and have $45 million in exclusions, because gifts of the stock are okay. But if you gift it to a non-grantor trust, that may not work well. So you have to be careful when you have a client that has 1202 stock. You have to be careful what you do with it. And because you can only gift up to $15 million income tax free, you can't sell it to a family member. It doesn't help to sell it to a grantor trust. And you can't sell it to a Section 678 trust, treat it as tax to your relatives, because that'll trigger income tax on the sale. So getting these companies situated now rather than later is important. But the 15 million per person exemption, up from 10 million, is pretty significant. What else would you add to that, Peter?
The 15 million will be indexed for inflation in tax years after 2026. The new holding periods where it goes, it's 50% exclusion if it's held for 3 years, 75 if it's held for 4 years, 100% if it's held for 5 years. That applies to stock issued after Independence Day, July 4th, 2025, which I think is if I remember, is the effective date of the new act. So you have to look at when the stock was issued.
So if you have an active business that's in an S corp or taxed as a partnership, you might consider establishing a 1202 management company and let the 1202 management company develop intellectual property for the business and receive management fees, and then reinvest the income that it receives in other business property, which allows it to be in active business. And then when you sell your business, you have the buyer allocate some of the money to the 1202 company stock that they buy. and that portion of the purchase price that you receive is non-taxable or taxable at half of the capital gains rate, depending on what the law will be at that time. But the challenge is that, and the other advantage is, if I'm in the 37% bracket and my 1202 company is in the 21% bracket, and then it's using the money that it earns to go buy, let's say, billboards. It goes and it buys billboards, which are used to advertise my business and other businesses. So it's in two businesses. One business is it's managing my business. The second business is it's buying billboards. So now it's worth $20-30 million of billboards in it. And this is more than we would have had because of the low tax rate. And now I find someone when I sell my business who also wants to buy the billboard company from the buyer. So 3 people show up at the closing. The person who wants the billboards and the person who wants the intellectual property and the seller. And the billboard buyer gets the billboards, the intellectual property buyer gets the intellectual property, and the seller gets more money and pays less taxes. So certainly that's possible. Now, the types of businesses that don't get a Section 199A deduction and that also don't qualify to be 1202 companies, it's the same list here on page 90. And it includes medical practices, law practices, accounting practices, actuary practices, knife swallowers and jugglers, consultants, athletes, brokers, but that doesn't mean that they can't have management companies that provide management services and may qualify under 1202. So
what about ventriloquists who are also attorneys?
Maybe. That they would have to be good ventriloquists, though. All right. So, Peter, we're at 2 minutes left. Is there anything else you wanted to make sure we covered? I think we covered a lot of things. There's certainly
I think
a lot.
so too.
Do we have any questions besides when will this darn thing be over? Okay. Must be 18 to take distributions from a Trump account. That is correct. There's a limit on the amount that can be deducted each year for automobiles was about 54,000 adjusted for inflation. That's good. By the way, I bought a Porsche Panamera and it didn't work well at all. I had to lemon law it. And then I bought a Cadillac Escalade and it's a great car, my first American car in like 30 years. And it's one of the nicest cars I've ever had. And unlike Marcia's Tesla, it has lots of buttons everywhere and switches. That's what I want.
You don't have to search through menus to turn on the
Right.
AC.
Okay.
Yeah.
Doesn't the 100-hour rule require multiple activities with the 100 hours? I don't know, James. I didn't think so. I think it could be any activity legitimately related to acquiring and conditioning an airplane or a boat, maybe including becoming a captain. Okay, did I say that land qualifies for 168N? Well, in case that's wrong, Peter said it. But Peter, you want to search for that and make sure?
Yeah, I think he's right. I don't think it's the land. I mean, I know is it's the cost of building that facility, that production facility.
Okay.
Because he's right, you don't depreciate land. In terms of the equipment and so on, I'd have to look at the statute. I'm not sure about that either.
And then he asked, does the accelerated depreciation bonus depreciation, is there a timing difference? And I don't know. By the way, we used to have to time our cars. I don't remember exactly how it works, but there was like a flashlight and a flashing thing. Does anyone remember that? Okay, Alan, let me see. Yep, again, correcting us that you can't depreciate land. Thank you very much. Okay, so 70 and a half was the required minimum distribution age when the QCD rule was created. That's correct, and it's still there. So they left that. Okay, let's see here.
Karen asks a new one, how can we rewatch the presentation? I think we typically upload, do we upload these to our YouTube page or?
First, I would get a dose of Thorazine, and then, yeah, what we're going to do is we email it. You can search Alan Gassman YouTube, and it'll be posted there next week. But also, we're going to email it. I think Brittany emails it to everybody. So, will the slides be posted soon? Did we not share the slides?
We did share the slides.
Okay, so the slides are in the chat thing or the.
Yeah, I don't know exactly what they call it, but if you watch these before the place you download the slides, they should be there. We posted them after Tomer asked the question, so.
Okay, so I want to show off Estate View, and this is where you can get the free trial on Estate View, and you don't have to buy it. You'll still be my friend. But I go to the home page of Estate View, and there's the home page. There should be a little picture of Lassie. There's no place like home, but we didn't do that. And then I can click on Instant Plan, and then I can add a new client, John Smith, and I can create him. Here he comes. So there's John Smith, and I'm going to go to the calculator only mode. So go to
under settings.
Go to settings and put in calculator only. All right. So I can give him an age if I want to. I can make him 30. He has a 52-year life expectancy. If he smokes, he's going to have a 43-year life expectancy. Is it worth 9 years of life to smoke? I don't think so. All right. So then I can give him a child. He's going to be rich, so I'll call his name Alan. Child's name is Alan Jones. And make the child 2 years old. Too young to use tobacco, by the way. And I'll give him 2 children. Maybe one he knows about and one he doesn't. Bart. We'll make Bart Sampson, so it's not a copyright violation. And then I'm going to assume that he's going to save $1 million a year. He must be a tax lawyer if he's able to save $1 million a year until age 75 when he retires. And then I'm going to give him a $3 million home. This is better than Ken and Barbie, isn't it? And a $4 million IRA. And outside of the IRA, he has investments of $30 million. And I'm going to make him a little bit older because I want to show the qualified minimum distribution. I mean, the qualified donation from an IRA. So, sorry, kid, you're now 69 years old. Well, let's make him 71 years old. All right, so that moves his life expectancy to 15 years. Click on results, and then I'm going to click on RMD. And that's not a rock band. That stands for Required Minimum Distributions. REM was a rock band. So the point I'm making is he probably should not, if he wants to give money to charity, he has coming up $172,000 minimum distribution in 2 years, whether he wants it or not, and he's going to pay income tax on that. So the after tax is not going to be 172. It's going to be 63% of that if he's in the highest bracket. So if he only wants to give a couple $100,000 to charity over the next 6 years, he should wait, because what he can do instead is let the money go to charity. He could give up to $108,000 to charity beginning now. and he may become charitable. So if he wants to give, but if he would prefer to wait, he can wait until he gets his 164 and then give to charity. Now, if he becomes charitable and he gives his IRA money to charity as much as possible, then the income tax savings will be over $1 million for his lifetime, assuming that he dies at age 90. If he dies at age 86, then the income tax savings will be $707 million. Now, the other thing that he might do is he may decide to give a gift, and let's just say the gift is going to be $19,000. So I'll go here to large gift, and well, I'll have to go somewhere else. I'll have to go to results and then save to calculators, click save, and then go to home, and then go to single person comprehensive, and there he is. So now what will it save if he gives away $19,000 this year? And I will go to let's see here. No annual gifting, no life insurance, one gift of $19,000. Go to gift. Oops. Large gift, and make the gift $19,000. Okay, so before the $19,000 gift, his estate tax is $28 million. After the $19,000 gift, his estate tax is $28 million. But the trust got $48,000 in 14 years. That's assuming a 7% growth rate. So let's say he has 10 nieces. So instead of 19,000, he gives 190,000. Now in 10 years, the trust has $489,000. So what's the savings? You go from 28.9 in estate tax to 28,765 in estate tax. So every year counts. Of course, he'd be better off doing annual gifting, but at least getting started, it's good to show that. Now, if I show annual gifting each year in an irrevocable trust, and I go to annual gifting here, and I have him gifting 19,000. Before gifting, he's at 28.9 million in estate tax. After gifting just 19,000 a year, he's at 28 million. The gifting trust, just on 19,000 a year for 14 years, has $1,458,000.
I think that is actually showing 2 gifts per year. An initial gift of 19,000 plus annual gifts of 2 annual gifts a year.
Oh, okay. All right. Okay, I guess he had that. Oh, that's right, because he's got the second child. So it'd be half that much for one person. But still worth doing. So, but now let's have some fun. We'll go to AI. So this is Estate View uses AI in the Amazon cloud, and it stays private. The Amazon cloud has treaties with OpenAI, Gemini, and Claude, which allow us to train it, and the AI does not learn from this. So I can go to tax returns here. I'll go ahead and start a new search, show you how it works. Click on start a new search. Now I can drag my clients or my personal tax return into this. It will stay private. If you're concerned about that, you could white out the client's name and etc. And then I will pick an engine. You can use Google, Gemini, OpenAI, or Claude. Claude seems to be pretty darn good. Then I click on tax return and I drag the tax return in, or I can pick Joe Biden's 2023 return or Elizabeth Warren's 2024 return. She made more money. I like her better because she made more money. So I'll click on that. So now it's reviewing Elizabeth Warren's tax return. And what I'm going to do is I'm going to say, assume that the publishing company or the publishing made 500,000 this year, and the rest was the same for 2025. What income tax planning can they do, and what should they do before the end of 2025? So now I'm going to click there, and it is responding. It's using Claude Fast. So for each of Claude, Gemini, and OpenAI, I have either Fast or Pro. If I go Fast, it does about 80% of the work quicker. If I go Pro, it's a little slower, and it does a little bit more. But I'm very impressed at what it comes out with. It goes through every important aspect of her tax return and talks about what can be done for both state and federal tax purposes. It summarizes it, then it categorizes the strategy by aggressive versus non-aggressive, and it even gives you a year-end implementation checklist. Now, what's kind of fun is when it's done, I'm going to ask Genesis to review what Claude did. And then Genesis is going to criticize Claude and find mistakes. But first, well, yeah. So I'm going to click on Review with Other AI. Now, we have features for reviewing legal documents and financial. You could review your brokerage statement for investment information. You can review your life insurance policy. But I like having one AI review the other. It will reduce or eliminate the hallucination issue. But they recommend that she set up a retirement plan for her publishing activities, that she consider an S corporation, that she accelerate her charitable giving, that she defer some income, and then there's other tactical moves that are enumerated here. So, Peter, I didn't really think of doing this until just before, but then this is great. One AI then criticizes the other AI. And it does a pretty good job, from what I've seen, of criticizing the other AI. So then I can go to regenerate, and it will regenerate. So you could also put her corporate tax return in here and her personal tax return in here, and also ask whether the return was prepared properly or not. So what do you think, Peter? Pretty cool stuff?
I think it's very cool. We had a question for, does the state view cover all states? Which is a great question. We've recently added estate taxes for New York, Massachusetts, Washington, Hawaii, Maine, Maryland, Minnesota, and Oregon. And we're working to add other states with state estate tax. So that's something we haven't always had, but we're very excited that it's a new feature. Alan's been working hard on that.
Well, what I've done here is, you'll like this. Please, well, I've just downloaded a trust agreement. You can see the trust agreement here. And now I'm going to go to amend trust, and I'm going to say add a scrivener protector provision, add trust protector provisions, and change situs or governing law. And then here I'm saying they are moving to New Mexico. Prepare a trust amendment to have New Mexico law apply once they move there. Now, I've got spelling errors here, but that won't stop it. It'll correct that. So then I'll collect now. So now what it's doing, and it'll take a little while, but trying to hide the document. But what it's doing at this point is it's going to prepare a trust amendment. For some reason, it's not hiding my document.
While you're trying to do that, I'll just mention the states I listed are the states where our calculators can calculate state-to-state tax. Like
that's right, because we weren't doing state-to-state tax before.
Right.
Now we are.
Right, but a state view AI, the AI system can analyze all 50 states. So we have options for all 50 states in the estate view AI tool. But our calculators will do state-to-state tax on those states that I listed.
Yeah. Well, it was working before. It seems to be stuck here.
I wonder if maybe you click download discussion on a Word doc. Maybe you could see the results on the Word document.
Yeah, I did. You're right. Okay. All right, let's see.
I think there's a little bit of issue right now on hiding the document once you pull it up that we'll have to take a look at.
Yeah, okay. Oh, there it is. Okay, well, there it is. It came up. There's my, oops. I wonder if I lost it. All right. Well, I'll be talking to the programmers at 1 o'clock to see what happened. Let me see if I can find it here.
It's probably search number 6 under tax returns.
Nope. Well, it was there. Anyway, I think we'll call this a day. Appreciate everybody attending this program. And Peter, thank you very much for putting the slides together. We welcome any further questions, comments, and suggestions. And have a fantastic day.
Thanks, everybody.